Mexico, Venezuela, Ecuador, Angola, and Nigeria, and the Middle East, and the North Sea. And they can have access to the Pacific and Atlantic Ocean, and so on. The Chinese, they have access here to the East and South China Sea, but they're surrounded by military and naval bases of the Americans, plus the Americans have 11 aircraft carriers. And 95% of the oil that goes here into northern ports of China comes here from the Middle East along the sea lanes. Now, if you were running a country of 1.3 or 1.4 billion people, and you depend 95% on oil from the Middle East, obviously the top priority is to get oil and secure the shipping lanes. But each time China undertakes some moves to build port facilities here around the Indian Ocean, it's perceived as aggression. But for the Chinese, this is a top priority to secure the oil. And so I believe that the tensions here in Central Asia will increase, and the Middle East. The Americans, they know very well, and the Western power, they cannot contain China economically, because China is already a very large economy, has 1.4 billion people and so forth. But one way to contain China is to switch on and switch off the oil tap from the Middle East. That is one way they can control China. And I think this has now also dawned on to the Chinese that this is a threat to their security. And so I think the tensions will increase. Aside from domestic social problems in the Middle East, in especially countries that have a large population like Egypt. In any event, believe it or not, I think that this is going to be very, very a powder keg. And that this could really have an impact on asset markets. Exactly how you should position yourself if war breaks out is probably that you have to own assets such as commodities, because during war times commodity prices go ballistic. Rising commodity prices lead to tensions. During war times they go ballistic. Equities probably will be okay, bonds less so in my opinion. The issue is China's oil demand has trebled in 15 years from 3 million barrels a day here in 1996 to now 9 million barrels. In the case of India, the same, but they are much lower, from 1 million to 3 million barrels. But India will have a larger population in 15 years than China. So I think the oil demand will go up, and the per capita consumption is tiny compared to countries like Japan and Korea and the US. So I think that the demand for oil will go up, and that we could actually see significantly higher oil prices. Now someone asked me, what happens if oil prices go to $150 or $200? It's not a prediction, I'm just saying we have to think what would happen. Well, I said, well, for sure, Mr. Bernanke will print more money. For sure. And so the commodities will go even higher. So this is one way to protect yourself, to be in some commodities. I believe we don't know how the world will look like in 5 years' time. I recommend to be diversified. I would have roughly 25% of my assets in cash and bonds. I don't like bonds, but you know, sometimes in life you have to do things you don't like. Then I would have some, say, 25%. I wrote here in Asian real estate. I was recently in Atlanta and in Phoenix. I think properties in the south of the US are dirt cheap, very, very cheap. For institutions, difficult to capitalize on, but as an individual you can buy homes for, say, 40% discount to the construction cost at the low level. Really. I mean, I live in Thailand. I can tell you homes in Thailand, of course, not luxury homes, but say for the middle class and lower classes are inexpensive. But I've seen in America homes that are cheaper. I mean, mind-boggling. And then equities, I would have some equities and precious metals, obviously, and I will explain to you now why I would have equities. I've said before that we have negative real interest rates. In the late 70s, you may recall, some of you who were born already then, there was a petrodollar boom because the oil price had gone up from $3 a barrel in 1970 to close to $50 on the spot market in 1980. The OPEC countries had huge surpluses. They deposited these surpluses with American banks. The American banks lent it to Latin America, so we had a credit boom in Latin America and an economic boom. After 1980, the oil price no longer went up. Then in 85, it collapsed, and we had the so-called petrodollar crisis. The reaction of Latin American governments, including Mexico, was large fiscal deficits and to print money, and so inflation accelerated. And one of the symptoms of this accelerating inflation was a collapse in their currencies everywhere in Latin America. In the case of Mexico, the Mexican peso between 1979 and 1989 went down by 98% against the US dollar. So if you invested here in 1979 in Mexico, you exchange your dollars in Mexican peso, after the currency dropped 98%. What was the way to protect your wealth in Mexico? What was the worst investment? The worst investment were government bonds with a fixed coupon, say 10%. Cash was slightly better because as inflation accelerated to 100%, the interest rates on cash also went up, but it remained negative. So you had, say, inflation 100%, but the cash deposit rate went up from, say, 5% to 60%. So, but at least you were better off than in government bonds. What about equities? You see, in an inflationary period, as I mentioned, some symptoms of inflation will come up, either in homes or in commodities or in equities, not all at the same time. So what happened in Mexico is eventually stocks adjusted on the upside because of the high rate of inflation. So you have the local index going here in 79 from essentially 1,000 to a peak of 343,000 in 87. Then we had a global crash in 87, everything went down, but we still finished at 139,000. So the index in local currency goes up from 1,000 to 139,000. In the meantime, the currency drops 98%. Did we make money or lose money? We can translate the local index into a US dollar index. So what you have is essentially an index where the stocks go up, as I just showed, but the currency goes down, but we adjust it continuously every year. So we start here in dollar terms between 48 and 70, and we drop to 5, and then we go up to 220 and close at 62. From start to end, at least in stocks, you maintained your purchasing power. It wasn't a very good deal, but you maintained your purchasing power.